All right, so just drop a 1 in the chat if you can hear me clearly. All right, amazing. Let's get started. This call is gonna be mostly technical stuff, visual, not too much psychology, not too much risk management, but I would advise that you should definitely take notes, because the smallest, simplest tips could be very valuable, you know? Right, so let's get started, right? Let's see here. It's not gonna be too long. It is recorded. So you can always look at it later if you need to leave, right? Okay, so basically this right here is just a little foundation you might need when it comes to trading, right? When it comes to your strategy and the rules that you follow. Just making sure everybody is on right now. Right, so what I wanted to go over is the trade entry criterias, the two types of entries that I use, where, what time do I trade most profitably, right? Now, everyone has their own trading strategy, their own system, but this is just what I personally use. So you could use that as confluence, or you could just use that as additional tips. But every strategy that is profitable is profitable. So as long as you could follow your strategy, it doesn't mean that you have to trade the exact same strategy that I follow, right? Drop a 1 in the chat if you're following so far. Now, the first thing we want to take into consideration, and that's something somebody mentioned to me today, is you have to treat trading like a business, right? And treating trading like a business simply means, defining your rules and following your rules, right? Rules could be, the time you put into trading, the research, the actual execution of the trading, and just being able to identify, what works, what doesn't work, and executing on that, right? There's a lot of self-analysis, just like how you would analyze the charts, is how you should analyze yourself, right? So when it comes to trading, before you could enter the market and execute on a trade, you first have to build a story, right? Now, typically, if someone comes on the chart and they execute a trade within the first few minutes, it's probably not going to be a high quality trade, right? Because you have to understand, you have to build the story and follow the story, right? In order to get to that profitable destination, right? And for me, the story is simply multiple time frame analysis and supply and demand, right? Those are two of the most valuable confluences you should learn, right? Because multiple time frame analysis is going to tell you the story of the market from the different time frames, and the supply and demand is going to help with just identifying, the direction of the market, where's the market coming and going to, right? And it's also going to help with identifying and executing on precise entry points, right? So simply put, Let's just go through multiple time frame analysis real quick, right? So let's say we're on US 30, right? And what I would typically do on US 30 is, or we could do Euro USD. Most of the time is US 30 or Euro USD, right? So right now we're on the weekly chart, and I could remove, all of the markups from the weekly charts and just place them on a lower time frame, right? So all the markups is on the daily, hours, and minutes, right? So on the weekly chart, you want to know what direction the market is headed on a weekly basis, right? So that way you have like a bias. Now, when you go down to the lower time frame, obviously you have to identify what phase the market is in. But at least on the weekly time frame, you have a bias to say, okay, the market is going down. So more than likely, once you could identify a downtrend, you have an idea, right? Now, typically I don't, I just glance the weekly time frame. Most of the time it's just the daily, 4-hour, and 15 minutes, right? 4-hour being the strongest. Most pairs would react way better off the 4-hour time frame. If you are a 4-hour time frame trader, a lot of your trades is going to work out, right? The reason being, the 4-hour time frame is not too high, it's not too low, but it is high enough to not be easily manipulated, right? Because we know the market is very manipulative. When the institutional traders, the banks, the hedge funds, the people with a lot of money, they would move the market prices slightly to fill their orders, right? Because a lot of the times the market doesn't have enough liquidity to fill the orders to go in a particular direction. So that's why these big firms and funds would create patterns in order to hunt your stop loss so that they could get their orders filled, right? Meaning that if they had to sell, let's say 100,000 contracts and there was only 90,000 available, the market is not gonna really go down until the orders are filled. So they would, if the market is going down, they would make it look like a buy so that you could buy, right? And buy fills sell orders, sell fill buy orders. So the more people buying, the more the smarter traders with the big money could get their orders filled, right? So they could, let's say, buy the market to push the price up a little, and then enter all the sales to bring it down. But on the 4-hour time frame, it's going to take a lot of money to move the market compared to the lower time frame, like the 15-minute, the 5-minute. It's not going to take as much money, right? So the reason why we would want to execute in 4-hour zones is because it's less manipulation, because the manipulation is much more expensive, right? So what I would do typically is map out the 4-hour supply and demand zones, right? So drop a 2 in the chat if you don't know what supply and demand zones are, and drop a 1 in the chat if you do, just out of curiosity. Okay, so simply put, a supply and demand zone is typically found on the valleys and the peaks of the market, which would be these zones, the edges, right? And supply and demand is, well, it could be, some people call it order blocks, and some people call it supply and demand, but they both have, depending on where you learned or who you learned from, they could have different meanings and different observations, right? But typically, it's where a big institution entered a large number of trades and the market moved down or up. But how the market works is, if they entered 100,000 cells right here, more than likely there wasn't 100,000 buys. So 50,000 cells might drop the market. However, the leftover orders is going to be as limit orders, right? So when the market decides to come back up because more people are buying, it could come back up to fill the limit orders for the rest of the trades to drop, right? Is simply, the number of buys and sells at a particular point, right? And these zones could look like this, right? Typically, you would find most of the zones right here at the edges of the market, right? But this is not a supply and demand lesson, but typically you would find the zones at the edge of the market. Supply is at the top, demand is below, and people would execute once the market comes back down to the zone to go higher, right? If it's an uptrend, you buy at demand. If it's a downtrend, you sell at supply, right? So if it's a downtrend and it's going down like this, then you would sell at the supply zones, right? And typically, once we identify who's in control, because you have to ask yourself who's in control, supply or demand. If demand is in control, you look to buy at demand and you expect the supply zones to be removed. And if supply is in control, you sell at supply and you expect the demand zones to be removed, right? As well as you could have what we call a continuation pattern. It simply means that the market didn't really pull back. We had an impulse up, we had a base, which would be the demand, and then another impulse up. And this would typically be where the demand is, right? So the supply and demand zones is really just a pause in the market, right? Because when the market is going up, we have more buys than sells. When the market pauses, we have equal number of buys and sells. And then when we have an impulse up, it takes a lot of money, typically a hedge fund, to fuel this move, right? And depending on how aggressive the move is, we could expect for the market to react once it comes back into the zone, right? But it's not a supply and demand lesson, so we can't really dive too deep into it, even though it's deep, right? Right. Right. So just drop a one in the chat if you follow so far. Okay, good. All right. So take, for example, the market came up here, it paused and dropped, right? Before it could drop, it has to pause. Now, this pause is simply equal number of buyers and sellers. And this drop was so big, we could expect that, okay, the type of money to fuel this drop is a lot. So if the market comes back to the zone, there's probably leftover orders for it to react off of, right? As sell limits. And then typically you could also have, it's usually at the valleys and the peaks, but it could also be in the middle, right? So let's find an example. Like this example right here, we had a rally, base, rally, right? I call it a base. So here we had the pause in the market, and then we had the impulse up, and the market came back to react off of the zone, right? But that's a lesson to dive into later on. So the point I was trying to make is on the 4-hour time frame, that's where I would highlight the high quality supply and demand zones, right? And I would wait for the market to come into those zones to make the trading decision. So I would highlight the 4-hour zones or the daily zones. The daily is just as important as the 4-hour, right? The daily may even be better, but it takes one day for our candle to move, which is a long time. So daily and 4-hour zones, they remain on the chart, right? So that we can identify when the market comes down to those zones. The daily is more so for the outlook, and the 4-hour is where I really look for the market structure, right? So what I would do is, if you're trading any pair, let's say any pair, anytime, if the market comes into a 4-hour zone and you're aligned with the order flow of the market, then there's a good chance it's going to be a high probability area, right? Even for volatile pairs, typically volatile pairs like US30 and gold, people lose a lot, right? But if those said persons just decide that we're only going to trade off of 4-hour areas, is going to increase the probability of them winning a trade much, much more, right? Right. So, that's typically multiple time frame analysis, identifying the trend as well, not just the supply and demand, but identifying the trend within the time frames, right? So you want to know what phase every time frame is in, right? Because here we might have a daily right here. Let's say this is the daily time frame, and then this is an impulse, this is a pullback, right? And then on the 4-hour time frame, let's say the blue is the 4-hour. The 4-hour time frame, we know, okay, we're in a pullback, we're in an uptrend on the 4-hour time frame, but a pullback on the daily, right? Which we know is short-lived. Basically, the more time frame you have aligned, the higher the probability of the trade working. So if you're in an impulse, right? Let's say you're on an impulse leg on a downtrend on the daily, right? And then the 4-hour starts trending down, then the probability of catching a nice trade down is gonna be higher, right? So you just wait for a pullback on the 4-hour to continue down with a daily impulse. If you could get 4 time frames, 3 time frames to align, it's gonna make the trade higher probability, right? And we know this game is about probabilities and defining your edge, right? So one thing to consider in supply and demand when you ask yourself who's in control, once the market taps a supply zone and it gives you the confirmation and it starts trending down, the market will typically trend down to the nearest strongest demand zone, right? So even if you didn't get in at the top and the market is on its way down, you could identify, okay, the supply is in control, so we could expect demand to be removed. If supply is in control, this demand zone is not gonna hold, right? That's why some zones hold and some zones don't hold, because it's a matter of who's in control at the moment, right? If demand takes back control and how it takes back control is simply removing supply. So let's say this demand zone, right? This is a weak zone, right? Because we also have to qualify the zones. And how to qualify the zone is simply the zone has to remove a previous opposing zone. So because this demand zone did not remove this supply zone, right? On its way down, we could expect this zone to be removed because it didn't accomplish anything, right? However, if it had removed this zone, then we could say, okay, this is a strong zone, it's in control, it removed that zone, so we could buy there. If it removed this zone and that zone, then that makes it even more stronger, right? So always ask yourself, what has this zone accomplished? Even this little zone right here, we had a nice pause, we had a big move up, so this would be a strong zone. It removed several previous zones, right? All of these are supply zones that was removed so that we know, okay, this is a strong zone. And as you can see, the market tapped it like 3 times before it could fall, right? So it's really, sometimes I would post outlooks, and those outlooks is simply identifying strong areas in which you could trade the market from, right? Drop a 2 in the chat if you're following. I'll take questions after. Okay, good. All right. Now, these are the 2 types of entries, right? We have the reversal and the continuation, right? The reversal is simply where you're trying to catch the top or the bottom of the market. And the continuation is where you're trying to continue with the trend, right? Now, reversal. If I'm expecting the market to reverse, this is where I would expect, let's say I'm expecting the market to reverse here, right? We identify the supply zone. We saw it had a big move down. It removed these zones. So we know, okay, this is now a downtrend. Once the market comes up, we can expect it to reverse and continue down. So what you would do is map out your zone, right? And then once the market approaches your area, you wait for the reversal signal. The reversal signal is simply the trend changing on the lower time frame. If you're on the 4-hour, you have your reversal time frame, right? We know the market is made up of impulse pullback, high highs and higher lows. Once the market breaks a low, from a fractal nature, this is a lower time frame supply taking control, removing a lower time frame demand. And if that is within a higher time frame area, then that would be the high quality trade. So let's say this is the 4-hour, right? And then this is the 5-minute. So this is the market just shifting the direction, right? And instead of taking the trade from the 4-hour zone, we take the trade from the 5-minute zone, because now, we have confirmation that the trend is changing and is about to drop, right? So let's see if we had that in this area. Okay, so here we're on the 5 minutes, right? This is the 4-hour zone. And if we look, we had impulse up, pull back, right? Impulse up. This was the impulse up, pull back, right? We had an impulse up, we had a pull back. And then now it's like we have equal number of buyers and sellers, right? Basically the market is shifting the direction, right? So in order to confirm that, the trend has changed, we need the market to start making lower lows instead of higher highs, right? This was the last high. This was the last high, right? So this right here is the range, because if this is the high, the low, the higher high, unless the market goes above this area, it has not making a higher high yet. And unless it goes below this area, it hasn't made a lower low yet, right? So right here, we had a volatile move to come down. This confirms the reversal. So what you would do, right? You would wait for the market to come back to the origin of that supply that shifted the trend, remove the low, and that's where you would execute, right? So right here, if we had to execute on this trade, we could see how volatile this move was. We could see that, okay, this is a lot of sells, a lot of selling pressure is coming in. We would have executed here, placed our stops above. If we wanted a tight one, probably would have gotten stopped out, right? Or you could have been like, I'll place my stops above the 4-hour zone. So at least I know that if I get stopped out, it means that the 4-hour demand is in control, because in order for demand to remain in control, it has to come above this area, right? So let's say you didn't get that entry. Well, once the trend is confirmed, right, you miss the reversal, you could go for the trend continuations, right? Because this is the reversal. This is the reversal right here, right? Once it breaks the low. However, if you miss the reversal, then you have to go for the continuations, right? Execute while it's trending down, because we have confirmation of the direction. You just have to find a high quality area, right? And then you could see we have, mini downtrends taking place. And you just draw out your supply zones. and wait for the market to come back into those high quality areas, right? That's just a quick analogy of what we look for a reversal setup. Usually, we wait for the markets to come into the higher time frame area, right? And then you drop to the lower time frame and wait for confirmation. Drop a 2 in the chat if you're following so far, right? Now, trend continuations is simply identifying that the market is in the trend and joining the trend. Identifying the supply and demand is in control and joining that chain of supply and demand, right? Typically, it's not at the valleys and the peaks. It's in the middle, right? So let's say we have these moves down. Well, Bitcoin may not be a good example, right? Let's go on Euro USD. Okay, so here we have the market making a strong impulse down without much reversals, right? The trend continuation is more so for, because we know the market doesn't always pull back, and a lot of the times you might miss the entire move, right? So let's have a look at this impulse right here and see if, there was any trend continuation patterns for us to join while it was on its way down, right? Right, so here we had a nice clear trend. Now, the valleys and the peaks are the supply and demand, right? So if we're in a downtrend, we're only selling at supply, right? So here we have supply where you could have sold, supply where you could have sold. This would have been supply. Basically, wherever there's like a point in the market, you could say like this, wherever there's this will typically be supply, right? But the trend continuation patterns comes when there is no point, when there is just a pause in the market. So this would be a pause right here, right? This would be a pause. This would be a pause right here, right? Basically, these candles may not look much like basin candles, but for these two candles, the market stood in one place, which means it had an equal number of buyers and sellers, right? And it could have only took a lot of selling pressure, a lot of supply to break out of that consolidation. So only when the market comes back to the zone, that's where you execute, right? And we know that, okay, when you have an impulse, the correction should be a small uptrend to make it higher probability for you to execute on the next impulse down. If you do have a impulse down and the market just impulses back up, then that's not a good sign. That means there's probably, buying pressure. A lot of buys is too volatile. But if the market slowly creeps back into the zone, it would make the probability a lot more higher, right? Drop a 2 in the chat if you follow so far. So your job is simply to train your eyes to be able to identify these zones, right? Identify these areas, right? So let's say we're on the 15-minute. On the 15-minute time frame, I would wait for the market to come into a 4-hour zone, right? So let's say this is a 4-hour time frame. We have a 4-hour zone. I would look at the 15-minute structure and execute based off of that. 15-minute confirmation is needed for 4-hour zones if you want high probability trades. And if you have a 4-hour zone, right? Because you can have zones within zones, right? So let's say you have a 4-hour zone and then you have a 15-minute zone within that 4-hour zone. If the market comes into the 4-hour and the 15-minute zone, then you could look on the 1 minute for confirmation, right? And that usually gives you the great risk to reward, because we know the higher the time frame, the most breathing room and the more space, even though it may be more probability, right? But if you see me executing on the 1 minute, is because we have the 4-hour aligned, the 15-minute aligned, and the 1 minute is confirmation. Or sometimes it may even be the 15-minute zone coming into a 1 minute area and using the 5 seconds as confirmation, right? Or the 15 seconds. Because the market is fractal. So, what happens on the higher time frame, obviously it happen on the lower time frame as well, right? So let's see. Right. So, you don't have to overcomplicate it. Whenever you're executing a trade, you should be able to tell, am I executing a reversal or am I executing a trend continuation? Typically, the trend continuation works the most because the market would, grab liquidity above reversal entries, or it will consolidate long enough for you to give up hope, enter early, right? But trend continuations is pretty simple. This right here would be an example of a trend continuation. We had a drop, base, drop, and we had a base. These 1, 2, 3, 4 candles is basing right here, right? So if you just want to take this area, then this would have been the entry for that. But you could still, once the market taps the zone, it doesn't matter if you enter the top or the bottom, but once it taps the zone, you can identify, okay, supply is taking control. So on the way down is where you would look for your entries or enter your entries, right? So drop a 2 in the chat if you're following so far, right? Okay, good. So basically, you want to know, the best times to trade, right? This is a very debated topic, but it's really up to you. You can look at your trading history and see where you win the most trades, right? But I could say, for me, the best times to trade would be pre-London, before London session, right? Let's say 2 o'clock. The market typically moves smoothly. Then London comes, it gets a little volatile. You could still trade London, right? And pre-New York. Pre-New York would be before 8 o'clock, 6, 7. That's when the market flows nicely, as in it respects the trends, it respects the zones. There's not too much manipulation, right? And if you can't trade those times, Asian and gold. Asian is you could trade gold and JPY pairs during the Asian session, right? And that's when the market would move smoothly. By the end of the day, you need to have your plan, you need to have your trading times, and you need to not be spending the entire day in the market, right? Less is more. So for me, I personally trade 11 and 2 because of the strategy I use. It tends to work at those specific times. New York session is way too volatile, way too disrespectful. When once the stock market open, we know how volatile it could get. And it don't really respect zones that much. But as the volatility dies down and the market decides which direction it wants to go, for me, I typically catch a move at 11 and 2. So you need to pick specific times in the market and back test those times, right? Because even though the market may seem very random, for some reason, if you break it down into a 1 hour or 2 hour block of the day, you would see very specific similarities an occurrence is happening at that time that you can base your strategy off of, right? Now, my advice also is you should spend 80% of your time studying and 20% of your time trading, right? The less time you spend trading is the better. You make less mistakes. If you make too many trading decisions, it's not going to be in your favor. So that's why I choose to spend majority of my time trading, back testing, not trading, but back testing, studying, right? And then with less time actually executing in the market, because once we mark up the charts, once we mark up the 4-hour zones and the 15-minute zones, there's nothing left to do but to wait for the markets to come into your areas, right? For you to execute. Not all the time you would come to the charts and just look at the chart and okay, it's going up, it's going down, and execute. No, you have to wait for the market to come into a high probability area, because there's areas that is high probability, and then you execute on your setup. So let's say you're on your session and the market is just in the middle of the supply and demand zone and it's not there yet. There's nothing you can do but wait for it to get into that high probability area if you want to take a high quality trade, right? Now, there's also times when not to trade, right? You can't trade when you're distracted. Distracted meaning that you're not focused on exactly what you're doing right now. You know, you can't trade when you could trade when you're distracted, but right now we're discussing what is going to increase your chances and probability of being successful. So trading when you're distracted, you can still be successful, but the chances of you being successful is much lower, right? Trading when there's news, a lot of times I'd find an amazing trade and not pay attention to the news. And then as soon as I'm in the trade, the news hits the next minute and I'm wiped out, right? So you always want to be conscious of the news, either trade before it or after it, right? When there's low volume, the market is just bouncing up and down, most likely it's going to drag its way to your stop loss, right? Now, because we typically execute for a high risk to reward, right? Let's say this is your trade right here. And typically we execute for a high risk to reward. If you enter the trade here and the market doesn't have the volume to push this far, it's just going to play around low volume. It may come up and then it may come back down and then come up and come back down until it hits your stop loss, because your stop loss is much closer, right? So when the market is playing around trying to make its decision, because your stop loss is much closer, it could easily get hit before it decides which direction it wants to go, right? So that's why you want to trade when there's not too much volume, but some volume. You don't want to trade after big wins, because after big wins, you're overconfident and you're going to risk the profit that you made, right? Because you're so confident and end up losing that profit. And you don't want to trade after big losses or losses, because a lot of the times you're just going to try to make back the money you lost, and you're just going to end up running that marathon, risking more money to make back the losses, to make more losses, to risk more money to make it back, right? And you don't want to trade outside of your plan. Your plan being, okay, many times it wouldn't be, let's say you get up, you're bored, it's not your session, it's not your time to trade, and you go ahead and you try to trade the strategy that's been successful outside of your plan, outside of your times, then the probability of that working is going to be lower. And typically, you know, it's not going to result in high quality decisions, right? So drop a 3 in the chat if you're following so far. Okay, great. So these are rules to consider. Follow your trading plan, obviously. You want to have this written down. What do you trade? Your favorite pairs to trade. When are you trading, right? Don't trade too much. Don't trade more than 3 hours a day. 4 hours a day is the max, right? Why are you trading? If you're trading, well, as a beginner, you should spend a lot of time in the market, right? But let's say you're already making some profit. You know how to make profit in the market. Typically, people are trading to make money, or they're trading to have more free time. When you made your money, turn off the charts. You made your money. Don't spend too much time on the charts, because obviously it becomes a job and you're not as free, right? Have you tested your strategy? Testing your strategy simply means executing your strategy maybe over 100 times, over 1,000 times. Could you look over your last 100 trades and critique them, identify what made you win, what made you lose, right? You have to test your strategy, know your strategy. Or if you're following somebody, test them, know their strategy, right? How many trades are you taking and the risk you're taking? So if you have a specific time block to trade, you should have an idea. How many trades am I going to execute during this time? If you're trading a funded account and you're only risking 2% on this session, then you know you could risk 0.5% per trade if you're executing 4 trades, right? If you're only executing 2 trades, then you risk 1% on a high probability trade, right? And you identify how much you're risking. Now, less is more. Unless you're a scalper and your strategy is based around taking 100 trades in a few minutes. But the less trades you take, the high quality trades you'll take, right? Let's say, for example, you limit your trading to one single trade per day. Now, because less is more, if you could only execute one single trade a day, you could almost guarantee that that trade is going to be the best trade that you could take, right? Because because there's a significantly less amount of trades, you're going to only want to take the best trade, because if you lose that trade, then you don't make money. You don't have another chance. So you'll probably wait for the best setup, the most confident setup to execute on, right? Drop a 2 in the chat if you agree with that, right? No. Right. So let's just go over what we've done so far, right? Like I said, you want to treat your trading like a business, define your rules and follow your rules. You want to draw out your higher time frame zones and wait for the market to enter those high probability areas. Follow your system and your strategy and let your edge play out. Understand that you don't know the result of one single trade. You don't know if one single trade is going to be a winner or a loser, but you know that your strategy works, and over a series of trades, you're going to be profitable, right? Review your trades and don't be scared to look at your losers. If you have a big loser, don't just close the phone or the computer and avoid looking at it. Spend time with your trades so that you're able to identify and learn from it, right? Take befores and afters. That's going to help a lot because the more before and after you take, the more confidence you'll build, right? And a lot of the times trading is about confidence. If you've seen this happen many times, you have before and afters you could look at, it's going to build your confidence, right? And hold yourself accountable to all of it. Hold yourself accountable to showing up on time. Hold yourself accountable to following your rules. If you didn't follow your rules, be honest with yourself. Look yourself in the eye and just tell yourself, I did not follow my rules today. And this is the result, right? Look out for the news and also identify what phase the market is in. A lot of people don't know what phase the market is in, right? If the market is in a correction, an impulse, or accumulation, right? Correction simply means the market just had an impulse and is correcting. So you see this lower time frame downtrend, right? Or the market is in an impulse. When the market is in an impulse, the order flow is going up, so it's going to go up rapidly, and it's your job to try to get into that impulse, right? And if the market is accumulating, it simply means it's gotten to an area where it's about to reverse and it's just consolidating sideways, most likely taking out the early traders right before it makes its decision to go down or to go up. You need to be able to identify what phase you're in for that specific time frame, because different time frames could be in different phases at the same time, right? Drop a 3 in the chat if you're following, and drop a 4 if the information I've given to you so far is helpful. Right. So another thing you want to take into consideration is what's going to really help you is instead of focusing on making money, focus on not losing a lot of money, right? So times where you could cut your losses short or just stick to your risk management plan, not take too many trades, right? Because by focusing on not losing a lot of money and keeping your losses small, you're gonna automatically make money, right? Drop a 1 in the chat if you can hear me clearly. Okay, amazing, right? So let's go to US 30. We had this big crazy move right here, but this is what I would typically do, right? We have, let's say, this big move right here. So what I would do is I would go on US 30, map out my 4-hour and 15-minute zones, right? So let's say this is a 4-hour zone right here, right? This would be a pause in the market. We're just mapping out the pauses in the market, right? Go down to the 15. You have to also map where the market is headed, right? So this would be the 15-minute zone is headed to right here. Right? And within that, now this would be an example of a continuation pattern, right? So this is one impulse on the 4-hour, but on the 15-minute, you have these little zones. Now, if we know the order flow is down, obviously we look to sell at supply, right? So here would have been supply areas. Once the market slowed down, this would have been supply, lower time frame supply areas to sell at, right? This would have been a pause in the market. This would have been wherever there's a pause and an impulse, that would be your area, right? And this would be a pause, right? Now, it may not look like a pause, but for example, for this candle, the market didn't really move anywhere, right? For this candle, it just went up and down. This candle stayed within that zone, right? So this is a pause in the market. So, and this was the impulse to break it out. And then this was the pullback. So this would have been the 15-minute area we could have looked for sells from, right? This would have been the next area right here. And this would have been the next area right here. This would have been the pause in the market. So for example, if US30 was to come up to this this area right here within my trading time, I would look to sell to continue with the trend down, right? So let's go down more to the 5-minute. So like I said, with my trading times, this is my trading times right here, right? What I've realized is that we typically have trading setups, mostly reversals within the times that I've traded and back tested, right? So I know that, okay, if I look at the markets between 2 and 3, or sometimes 4, we would find the market would find the area to give that reversal to continue the trend for the rest of the day, right? And typically at 11. So let's say we were trading at 11 around this time, then this would have been, within this blue area, this is where I would need to execute. Within this highlighted purple area, this is where I would need to execute, because this is between 11 and 12:30, and this is between 2 and 3:30, right? So if we have the supply zone right here, I would execute on either one of these on the lower time frame confirmation, right? And not sure if I did send this out, but just looking at this, I could identify, okay, the market is coming into a high probability area around my trading time. So this is where I would drop down to the 1 minute if I don't see it on the 5-minute, and wait for the confirmation, right? So right here, let's say we're not using the seconds time frame. This would have been 1 minute confirmation right here, right? The market tapped the supply zone, the 15 minutes. We had a change of structure on the 1 minute, right? And if we had to execute, we have this drop base pause that removed all these zones, this trade continuation pattern that removed all these zones right here to execute from, right? Now, this was a little outside of the trading time, but the trading time could run to 4 o'clock sometimes, but most of the time the trade would come between 2 and 3, right? And then, it's just a matter of holding the trade until the next day, or, as long as you could, right? Here, for example, this would have been the 11 o'clock, but, a lot of the times it'd be from 11 to 3 on US30 would find good opportunities, right? Now, the reason why, I could be confident in that is because I would highlight the times and I would go back and replay the charts and practice executing when the market gets to my specific trading time, right? If it comes into the zones. And if you look at the times, you would see one sec. Right. So if you look at the times, you would see the market typically starts beginning to trend at that time. So this is 11, right? This is 11. The market started its downtrend. This is 2. Well, it consolidated, but eventually it trended up. This is 2. We had an uptrend. This is 11, downtrend to the uptrend, right? 11, downtrend. 2, the trend continues, right? Go back, trend continues. Trend continues, right? But, take into consideration, these moves might look small right now, but a lot of the times they're executed on the 1 minute or the seconds time frame. So the risk to reward is going to be up. And at the end of the day, if you could catch a trade on the lower time frame, let's say the 1 minute or the seconds time frame, and that trade eventually lines up with a higher time frame, let's say a 15-minute or 4-hour, then you would have put yourself in a position to execute on a low risk trade for potentially a high reward, right? Thus, making your edge play out. So we could take, any questions you might have. I'll take the questions now. And, the next training is going to be on risk management, right? Risk management and trade management whenever I decide to do the next training. I use the sessions indicator. I just search sessions and then I edited it to show my specific time. So instead of it showing New York session, I placed New York session for a specific time, and then I placed London session for a specific time. So that's the time that shows up. Do I use the Asian range? Sometimes I take it into consideration, right? Okay, great. So I'll probably be sending out some signals this week. I dropped an application form because I'm very much considering doing private signals and lives for people who specifically focus on their challenges. So it's going to be a small group. So go ahead and just, fill out that application and I'll have a look at it, right? And I'll obviously be able to communicate with you through that. But, if you had a great session, just take a screenshot, tag me because it goes a long way, and, comment so that I actually know, my time was useful. So I'll feel more motivated to do the next training on risk management, right? But other than that, have a great day, guys, and have a great, trading session this week.